The wealthiest people I've met don't look the part. No flashy cars, no designer labels, nothing that screams money. At the grocery store, they're indistinguishable from everyone else. But behind the scenes, they're methodically building serious wealth. While most people focus on appearing rich, they're focused on becoming rich. Here's the reality that changed my perspective. The median net worth in the US cites around $193,000. That's the midpoint, meaning half of households have less. Yet the average exceeds $1 million, pulled upward by a relatively small group at the top. Meanwhile, about 60% of Americans live paycheck to paycheck, including more than 20% of six-figure earners. So this isn't really about income, it's about behavior. Today, we're breaking down 7 habits of people who build real, quiet wealth. Not the kind you see online, not performative wealth. Actual financial stability that lets you sleep at night. And we're backing it with numbers. Habit 1. Automate everything. Quietly, wealthy individuals remove themselves from day-to-day financial decisions. Their system is automatic. Income comes in, and it's immediately allocated. Some to investments, some to bills, some to savings. No second guessing, no impulse interference. Why? Because the biggest threat to wealth isn't poor investment choices. It's emotional, in-the-moment spending. You're tired, you see a deal, and suddenly 300 euros disappears. Automation eliminates that risk. Here's how it plays out. Contribute $500 per month into an index fund averaging 7% annually. After 10 years, about $86,000. After 20 years, about $260,000. After 30 years, over $567,000. You've personally invested $180,000. But compounding generates nearly $400,000 on top of that. A strong tactical move. Max out a Roth IRA. In 2026, the contribution limit is $7,500 per year. If you automate that consistently, you could be sitting on $300,000 plus in 20 years, and it's tax-free. Research consistently shows the average investor captures only approximately 3% annually, largely due to poor timing driven by emotion. Automation neutralizes that behavior. Wealth isn't built on discipline alone. It's engineered through systems that remove decision friction. Habit 2, buy less, but buy better. Quietly wealthy individuals don't necessarily spend less. They optimize spending. They evaluate purchases through cost per use. A €300 pair of boots that lasts 10 years costs €30 per year. Buying 5 €60 pairs over that same period yields the same total spend, but lower durability and more hassle. Scale that thinking. A €1,000 energy-efficient refrigerator saving €200 per year pays for itself in 5 years, then generates €2,000 in net savings over the next decade. Instead of leasing new vehicles, they might buy a 3-year-old Toyota Camry or similar and keep it for 8 to 10 years. That avoids steep depreciation and can free up €5,000 to €8,000 annually. Redirect that difference into investments, and the compounding effect becomes significant. The broader system nudges constant consumption, planned obsolescence, fast fashion, subscription creep. Quiet wealth resists that pressure. Every avoided expense becomes deployable capital. Habit 3. Focus on net worth, not income. This is where perception diverges from reality. Person A earns $100,000 per year with a $50,000 net worth. Person B earns $60,000 per year with a $200,000 net worth. Person B is materially wealthier. Using a conservative 4% withdrawal framework, $200,000 generates approximately $8,000 per year passively, while $50,000 produces approximately $2,000. Income drives lifestyle. Net worth drives independence. Tracking matters. Net worth equals assets minus liabilities. Without measurement, there's no optimization. Even incremental adjustments, like allocating an extra $200 per month toward high-interest debt, can increase net worth by double digits within a year. Income is visibility. Net worth is actual position. Habit 4. Think in decades, not days. Time is the dominant variable in compounding. A $10,000 investment at age 25 growing at 10% reaches approximately $452,000 by 65. Start at 35, approximately $174,000. Start at 45, approximately $67,000. Same capital, completely different outcomes due to time horizon. Add consistency, $500 per month starting at 25 at 10% to approximately $3 million by 65. Start at 35 to approximately $1.1 million. That 10-year delay costs roughly $2 million in opportunity. Vehicles like a 401k's plan allow contributions up to $24,500 annually. 2026 limits. Quietly wealthy individuals prioritize maxing these, not because they already have wealth, but because they've committed early to long-term compounding. Time is the only non-renewable asset in this equation, and they allocate it accordingly. Habit 5. Build hidden income streams. Quietly wealthy people rarely rely on a single paycheck. They diversify income the same way they diversify investments. Most people depend entirely on one employer, meaning if that income stops, everything stops. That's not stability, it's exposure risk. The quietly wealthy reduce that risk by stacking multiple streams. Dividend income from low-cost ETFs, small digital products, templates, guides, consulting, tutoring, or freelance work tied to existing skills. Even modest numbers compound. 3 income streams generating $300 per month each equals $10,800 per year. Invested at 7% over 20 years, that grows to roughly $475,000. That's nearly $500,000 built from relatively small, scalable streams. The key point isn't just growth, it's resilience. With multiple inflows, a single job loss doesn't collapse your entire financial structure. The practical approach: start with one stream based on what you already know, then layer another over time. This isn't about overextension, it's about gradual diversification. Habit 6. Resist lifestyle inflation. Income increases don't automatically translate into wealth unless controlled. Most people receive a raise and immediately expand their expenses. Better car, higher rent, more discretionary spending. Within months, they're in the same financial position, just at a higher income level. Quietly wealthy individuals do the opposite. They capture the majority of that increase and redirect it into assets. Example, investing $7,000 per year, 70% of a $10,000 raise, at 7% over 20 years, results in roughly $287,000. That's not from earning more, it's from keeping and deploying more. The car example is even more striking. The average new car payment is about $730 per month. If instead you drive a paid-off, reliable vehicle and invest that €700 to €730 monthly difference, at 7% over 20 years, approximately $380,000. That's the opportunity cost of lifestyle inflation. The pattern is consistent. Every upgrade in lifestyle has a hidden long-term price. Quietly wealthy people evaluate that trade-off and often choose investment over immediate consumption. Almost $400,000 from a single decision about a car. Every dollar has 2 possible lives. You can spend it once today or invest it and let it multiply over time. The quietly wealthy still enjoy life. They just never sacrifice their future to do it. Habit 7. Stay calm in chaos. This final habit might be the most important of all. When markets crash, most people panic and sell at the worst possible moment. For example, if your portfolio drops from $50,000 to $40,000 during a downturn and you sell, you've locked in a $10,000 loss. But if you hold, history shows recovery is the norm, not the exception. The S&P 500 has recovered from every major crash and gone on to reach new highs. After the 2020 crash, markets rebounded to all-time highs within months. After 2008, long-term investors saw substantial compounding gains. The quietly wealthy don't just hold during downturns, they often buy more. To them, crashes aren't disasters, they're discounts. This mindset only works because of preparation. They maintain 3 to 6 months of living expenses in a high-yield savings account, earning around 4 to 5%, creating a buffer that prevents them from selling investments under pressure. Even that emergency fund quietly earns interest, money that grows simply by staying stable. A $20,000 emergency fund at 5% produces about $1,000 a year without any effort. The difference isn't emotion, it's structure. They don't react to volatility, they plan for it. And that patience, over time, is worth millions. Why these habits work together? These 7 habits compound in more than just financial terms. They reinforce each other psychologically. Automation reduces decision fatigue. Smarter spending stops unnecessary leaks. Net worth tracking builds clarity and direction. Long-term thinking removes emotional noise. Multiple income streams create resilience. Resisting lifestyle inflation preserves gains. Staying calm in chaos turns volatility into opportunity. Together, they form what you could call a quiet empire. The median household net worth sits around $193,000. But individuals who consistently apply these principles over 20 to 30 years often cross the $1 million threshold, even without high incomes. Not because of luck, not because of connections, but because of structure, discipline, and time. And that's the key point. None of this requires exceptional privilege. It requires a decision. And that decision can be made at any time. So here's the challenge. Pick one habit, just one. If you've never automated your finances, start today, even $50 a month. If you've never tracked net worth, calculate it tonight. If you've just received a raise, decide now how much goes toward your future before your lifestyle adjusts upward. One habit, one decision. That's where quietly wealthy people begin. And over time, that quiet beginning compounds into something much larger than most people expect.